The Santa Claus rally and the January trifecta was a complete disappointment after setting a clear lower high. This week, which is a shortened week of trading, the SPY needs to hold a key level, otherwise we can witness few painful moments. With that being said, my name is Akash, welcome to the weekly trading show, and let's dive straight into the chart. Starting off with the things on SPY monthly time frame, let's observe the candle structure. What do we see? A higher high and a higher low. The trend remains in uptrend and will remain in uptrend on the monthly time frame as long as the price is above 533. Moving on to the weekly time frame, this week's candle is exactly opposite to the previous one. The trend remains neutral as we can clearly see that a lower high is set up. However, there is an equal low with the buyers stepping up at the lows around at 581 area and pushing the price right back up above the opening print. Moving on to the daily time frame is where the things get interesting. The important key level which I was talking about in the introduction is 586. Any look below and failure to hold this level or setting up a lower high will result in the price moving down to 571 level, which will close the election gap up. Price trading between 590 and 595 is a no trading but a careful watch zone for me. Let's talk about various trading possibilities and outcomes for the coming week. Any consolidation between 590 and 595 area is a no trade but a careful watch zone for me, and any consolidation with a bullish price structure is bullish for me, but be careful, it can also turn out to be look above and fail and a rotation back into the 586 area. Any consolidation or setting up a higher high above 595 would be the ideal condition, as it can rotate price back up to 603 and then up to 610. Any consolidation straight down and setting up a lower high below 586 will be absolutely bearish, resulting to 571 price area for the gap close. Moving on to the Nasdaq side of the market and starting off things with the QQQ monthly charts. And there is this infamous doji candle that everyone is talking about. The trend does remain in uptrend but with heavy pressure from the sellers at the all-time highs. Moving on to the weekly time frame. The weekly time frame, the candle structure is exactly similar to that of the SPY. The candle is completely opposite of the previous one. The trend has now been shifted to a downtrend with lower high here and a lower low. The buyers did step up at the lows and did push the price back up to the opening print. However, they were unable to close in or above the previous week's range. If we bring out the Fibonacci's, give me a moment. If we bring out the Fibonacci's and take the measurements from the lowest low, from the recent lowest low to the recent highest high, we'll see that price did react well off at the 61.8%, however is still below 38.2. The key level here is, as I said, must be 510 area. If the price falls below this 510 area, it can result up to into the rotation, and we can see the lower lows in the Qs as well, which will create further downward pressure on the SPY. Let's get more granular by observing things on the Q's daily time frame. This look above 516 can really quickly turn into look above and fail at this 516 level and can result into the price rotation to the downside. However, any move back up above and setting up a higher low above 522.47 will result in a bullish outcome. Any consolidation in this area, which is 516 and 510, is nothing but a bear flag consolidation and can result in the downward rotation of the price and check the 496 level. Any consolidation between 516 and 522, which is this area, is a no trade zone but careful watch zone for me. Any higher low above 522 and consolidation between 516 and 522 is bullish for me. Any lower high below 510, which will be this area here, can result into the rotation of the price, and any consolidation between 516 and 510 is nothing but bearish for me and can be classified as bear flag consolidation. Let's take our discussion further and discuss how the doomed Santa Claus rally is affecting the small caps. Starting off with the objectives for monthly time frame, the trend on the small caps remains neutral with almost equal highs and slightly higher low. Breaking out the Fibonacci suggests price is resting well at 50%, further confirming the trend analysis. Small caps must need to hold 219 level. Weekly chart. Weekly candle in the small caps looks much better than the SPY and Qs and is showing some sort of strength, with solid green bodied bar having higher highs and buyers stepping up at the lows and pushing the price back above the opening print and above the previous week's range. Taking things further onto the small caps daily time frame, we can see that small caps are tightly consolidating between 225 and 219 area, which is this area right here. Any sort of price action which makes higher low above 225.51 is bullish and can test back up to the range of 232, which is top of the range. Lower low below 219 would be excruciatingly painful for the small caps and the overall market in general, making it test the price targets of 207. In conclusion, after carefully analyzing the different segments of the market, it is safe to say that this week is definitely the week where you need to stay patient. Price can rotate off to the either side of the key levels. If small caps fails to hold 219 level, that will cause a huge downward pressure on the SPY. Qs still looks like a place to be bullish with caution. As a trader, our job is not to be biased but to trade the situations as presented by the market. With that being said, I hope all of you have an amazing trading week. See you in Wednesday mid-market update video. Until then, stay green.